Hello and welcome to Weekend Investing Daily Bytes. Today is 15 September and we are shooting episode number 93. We're going to discuss a usual mistake that a lot of investors do, which is to sell the first big rally in their stocks or buy the first big fall. What happens is that stocks, once they are in a certain price range, and they move out of that price range based on either some fundamental change or some expectation, and they begin to move out of the range. A lot of people who have been used to seeing that stock in that particular range think that the range will play again and the stock will move down in case it is moving up, or the stock will move up in case it is moving down, but doesn't happen so in a lot of cases. So we will consider some charts and see what is this breakout and breakdown mentality, if you can call it, how we can improve upon that. So before that, let's take a look at the markets. So markets were very, very strong. PSU banks were on fire, especially after the government announced some measures for telecom companies, and based on the huge amount of indebtedness several telecom companies have, the banks have got a breather in terms of the long gestation of the payback period for the loans, etc. So PSU banks were on fire. Public sector enterprises in general, that index has been going up as we've been talking last many days. IT stocks were remarkably strong today, and the first result of the season, Infosys, will be coming out in a few days. Energy, infra, commodity stocks, auto stocks, pretty much everything across the board was going up. So pretty good day from a breadth perspective. In terms of the indices, Nifty closed up 0.8%, and most of all indices were 0.5% to 1% up, including mid cap and small caps. In terms of weekend investing, small cases also 0.5% to 1%. Most of the strategies were up, with MI25 gaining the most at 1.19% and MI35 being flat today. The last 3 months, if we see, MI ATH2 and MI50 have done the best, followed by MI MT All Cap and MI20. Strategies can have periods of underperformance or outperformance, need not be exactly in line with the underlying index depending upon the stocks that they are picking, but over a longer period they will either catch up early or late. Let's now look at the topic of the day. So do not sell the first big rally, buy the first big fall is the topic. I had tweeted yesterday about this, and there was a lot of comments and discussion about it, so I thought I'll pick it up for today's Daily Byte. So let's dive into this. So we'll take examples of stocks where this kind of a bias or a behavioral issue happens, and it happens when there is a long consolidation. Like in this example, this is Tanla Platforms, the monthly chart. Over several years, the stock has been moving, in somewhat a range of 40 to 80, 90, this kind of a range. And then it broke out somewhere after the COVID crash, somewhere in July or August 20. And a lot of people who have been in the stocks since the last 2, 3, 4 years may have, just given up on their holding and sold it near 80, 90. I remember in our small case MI25 and MI50, I think we bought it at 87 rupees, and it was seemingly a very high price, obviously, because it had broken out of the range and it was near the all-time or recent highs of last many years. But that's what the nature of that strategy is. However, for conventional investing, a lot of people may have thought that we will sell out at 100 and get it back at 40 in a few weeks time or whatever, and just let's see what happens later on. And this is what happened to the stock. So it went from 100 to about 1,000 within the next 6-7 months. And yes, it has consolidated there, and the next move is not known whether up or down. But because of this first move up here, had somebody sold into this, you would have missed this entire move despite having waited for so long. You may have been waiting for 3, 4, 5, 7 years. And this huge move, when it started to come, you got out of it right at that point and you gave up the entire gains. Even if you had trailed it in some way, a very good trailing method may be some ATR or some moving average based or some RSI based. There could be so many things, but that's besides the point. The point is that the first move up, you have to give probability that yes, there can be much more ahead. Even if you wanted to sell after the first move, maybe at the bottom of the first move candle you can place your stops. That at least if it comes back, yes, I will lose this opportunity, but if it goes like this, at least I will not lose that opportunity, right? Another example, very recent one, very good example actually, is Heikel. This has been a range bound stock for so long, and last three years it was ranging between 200 and 50 rupees, and as soon as it broke this range, and it was very beautifully defined range here, a lot of people may have sold here, right, at 200 rupees. Just see what happened here. 5 months straight to 706, still going strong. I don't know where it will go, but the opportunity of and also see the volume candle on this breakout first move. So if the first move was very strong with very, very high volumes, that would have even told you that you should maybe wait a bit, or maybe book a small amount if you wanted to really book, but at least let the winners run. That is the whole idea. Adani Enterprise did the same in 2020 after the COVID crash. As soon as it hit a new high, a lot of people wanted to get out, and this is what it did. It from 150 it went to 1500, 10x in the last year or so. So a lot of opportunity may have gone waste because we were panicking to sell out. Now another type of example is on the downside, when the breakdowns happen. Again, a lot of times stocks range in a certain region, or price stabilizes, and once the price breaks down from those stable regions, many times we want to add more there. That the stock has come to the cheapest in the last few years, so let's add there and we can wait out later on. So this happened in Idea several times, but in this example it happened again near 40 rupees where the stock broke down, and then people bought here thinking that it will come back up, but it just kept dropping, and it went to 8-9 rupees or even 4-5 rupees at one point of time. Wockhardt, another prior year favorites, it was ranging here, and then once this pivots broke, you would have bought this move up thinking that it will come back into the range, and then it just dragged you lower and lower from 1000 rupees down to 200 rupees. So there can be immense amount of loss if you buy the first dip. If you want to buy the first dip, buy it with a small quantity, test out the dip. If the dip is in your favor, if it starts moving up, maybe yes, once it comes back into the range, maybe yes, you can buy more. Maybe you can put some stops there once you have had the taste of the position moving in your favor. One of the biggest strategy of successful traders is that they test the waters. So if you read the book Reminiscence of the Stock Market Operator, he was testing the waters by doing a reverse trade. So if you want to buy something, and if you are a large trader, you sell some quantity and see how much is getting absorbed at what rate, to get a sense of what is the depth in the market. But of course, we are not that kind of traders. We are small investors. So what we should do is we should test the waters by doing one trade of 10% quantity, 20% quantity, and see where it goes. If it starts to go in your favor, at least you know that your direction is right, and now you can build on that. But if you put all your eggs suddenly at the first drop, then if it goes lower, then you are just waiting, right? So Syntex Plastics is one example that I remember. I had bought into Syntex Plastics in a discretionary trade many years back, and there was some demerger. And although this is showing a range here, I was looking at this pivot where the stock listed, and it created a low of 100 rupees, and then it retested 100 and it started to wiggle around here. And so I decided, if it breaks 100 and goes to a new all-time low, I'll get out. And I sold off at 100 here, and then it just kept dropping. This is going to 19, but it went actually to 1 rupee or something like that. So you must have a strategy of how you're going to deal with price breaks up or down. And this is just a very small example of how you should go about it. I hope you like these videos. They are very I would say common in terms of whatever we are sharing. There's nothing new in it. You probably all know it before. This is all being done so that we can keep refreshing these ideas and make use of them in our investing. This also does not have much to do with our products as such, but in general, if you are a discretionary investor, then these tactics or these strategies can help you in your decision making. So thank you very much for watching, and I'll see you in another video. Bye.